Hello and welcome to this edition of Wealthtrack. I'm Consuelo Mack. How much do you pay in investment fees every year? What is the actual dollar amount you pay to your financial advisor, let alone the mutual funds you own and the firms that have custody of your investments? How much do they really take away from your portfolio and its performance over the years? Well, according to a groundbreaking article by legendary financial consultant and Wealthtrack guest Charley Ellis, investment management fees are much higher than you think. As Ellis points out, the little over 1% of assets paid by most individuals and little less than 0.5% paid by institutional investors are seen as so low that they are almost inconsequential. Well, it turns out they are anything but. As Ellis points out, investors already own those assets, so investment management fees should really be based on what investors are getting in the returns that managers produce. Considered that way, fees are much higher. Pension giant CalPERS, the California Public Employees Retirement System, earned just 1% on its $233 billion investment portfolio in the past fiscal year. If it were to pay the average 0.5 percentage point charge on assets under management, the fee would equal 50% of their return for the entire year. The financial toll investment fees take on portfolios over the years is stunning. Financial thought leader Charley Ellis is a world-renowned investment consultant to governments, institutions, and the financial industry. He has authored or co-authored some 18 books, including the investment classic Winning the Loser's Game, and more recently with Princeton economist Burton Malkiel, The Elements of Investing. And he is devoting a great deal of his time to helping individuals become better investors. I began the interview by asking Charley Ellis how much higher investment management fees are than we think.
It depends on what you're thinking, but most people, honestly, most people think the fees are roughly 1%. That is low. Compared to anything else, you buy and sell a house, 1% commission, you think, my God, that's really low. It just doesn't happen that way. And if you look at it that way, fees are low.
Right, and it's 1% based on the assets under management,
right.
For instance. So you have a $100,000 portfolio, it's a $1,000 fee. Nothing.
Right. The problem with that way of thinking is it doesn't reflect any economic reality. For an example, if you're an investor, you already have the assets. So you're not getting the assets, you're getting something else. What are you getting? You're getting a return on the assets. Okay, so what's the fee on return? If you take the kind of return people are expecting from the now out over the next 10 or 15 years, you're paying about a 15% fee. That's not low, that's a pretty high fee. That's twice as much or more than most people say would pay for a house sale or transaction. It starts to look like a pretty good profit margin even for a pharmaceutical company. That's a lot. But that's not the right way to look at it, and that's not the whole story. It's actually a great deal higher than that.
And that's a change, Charley. You have been in the financial business for 50 some odd years. You started as a very young child. And it was not always this case. So I mean, how did we get here? I mean, how did we get to where 1% is the norm, and even that's not real?
Well, for 50 years I've been working with investment management firms, and the basic metric has always been the same. You can increase your fees, and if you do increase your fees, nobody seems to mind, and you can increase your fees again, and nobody seems to mind, because everybody says you would never comparison shop for price if you needed brain surgery. If your family was faced with a major lawsuit, you wouldn't concentrate on the price of a lawyer. You're looking for skill, and if you want to get great skill, you have to be prepared to pay up. And those who traditionally have had the lowest fees for active management have been not particularly skilled and not particularly well represented as to what their capabilities were. So we looking for value, we look for best indication of value in most markets is price. So we are prepared to pay a price in order to get good value. After all, my family is dependent upon it, I'm dependent upon it, I want the best. And if you want the best, you pay up.
So where is the flaw in that argument now? Because you have said that, in fact, the market has changed now. And so buying the best, whatever the best is, the best has changed. So how has the market changed, in which case that model doesn't really work anymore?
Well, the main change is there's so many truly wonderful, brilliant, hardworking, well-educated, slaving away at it, people trying to beat the market. that there are just too darn many of them for any one of them to be able to do better than the crowd. And if you believe, as I do, in the value of prediction markets, there's been no prediction market in the world with as many people putting real money into it and really doing the research and being free to make any choice they want to make and working at it all the time. So they got it pretty well right. Not perfect, but so much better than it ever has been before that it's very hard for anyone to do better than the crowd. And it's even harder to figure out who is it going to be before it happens.
So Charlie, are some of the most influential institutional clients, probably at your behest, starting to question the fee structure? Is there any change occurring?
Gently questioning would be about as far as most people take it.
And why is that?
But there is a different way of answering a question which takes us to the, well, what about active management versus passive management, which is a really important proposition. And if you look at the data, it's very clear that institutional investors and individual investors, but particularly institutional investors, have been increasing. The number who invest in passive has gone up and up and up every year. The percentage of their assets individually that goes into passive goes up and up every year. So two of the major forces are increasing steadily and never reversing. And the reason for that is partly fee and partly the imperfectibility of active management. So that if you really want to get a reliable result and you would like to save money in doing it, going to what bothers most of us as individuals quite a great deal. I don't want to settle for average in anything else. Why should I settle for average in this? It turns out that is not average. That is comfortably above average.